In 1977, a 33-year-old man was handed the keys to one of the most powerful investment funds in the world, Fidelity Magellan Fund. At the time, it had $18 million in assets. The man had no special algorithm, no secret formula, no team of supercomputers running market predictions. What he had was something far more powerful. He paid attention to the world around him. He noticed which restaurants were always packed, which stores had lines out the door, which products his wife came home raving about, and then he invested in the companies behind them. Over the next 13 years, Peter Lynch turned that $18 million fund into $14 billion. His average annual return was 29.2% every single year for 13 consecutive years. He became the greatest mutual fund manager in history, and his secret was something that Wall Street did not want ordinary people to know. You already have an advantage over the professionals. You just do not know how to use it yet. Peter Lynch was born in 1944 in Newton, Massachusetts. His father died of cancer when Lynch was just 10 years old, forcing his mother to go back to work. To help support the family, young Peter got a job as a caddy at a local golf course. It was on that golf course that his education in investing began. The men he caddied for were executives, business owners, and investors. They talked about stocks the way other men talked about sports. Lynch listened. He absorbed everything, and he became fascinated. At age 11, he bought his first stock with his caddy earnings, a regional airline company called Flying Tiger. It went up significantly, helping pay for his college education. Lynch later joked that the stock went up because of the Vietnam War, not his investment genius. It was his first lesson in the difference between being right and being lucky. He studied at Boston College, then served in the military, then returned to Fidelity as a research analyst in 1969. He worked harder than anyone else. He visited hundreds of companies every year. He read every annual report he could find. When he was given the Magellan Fund in 1977, it was considered a small, difficult assignment. What followed became one of the greatest investment stories ever told. Lynch's most revolutionary idea was not a formula or a system. It was a belief. He believed that ordinary people with no finance degree, no Bloomberg terminal, no access to inside information, had a genuine advantage over Wall Street professionals. Not despite being amateurs, because of it. Here is why. A professional fund manager at a large institution cannot invest in a small, unknown company without serious risk to their reputation. If they buy a tiny restaurant chain nobody has heard of and it fails, they look foolish. They lose clients. They lose their job. So professionals cluster around the same large, well-known, already expensive stocks. The same names everyone else owns. The safe choices. But you have no such restriction. You can walk into a restaurant and notice that the food is incredible and the place is always full. You can see that the queue at a new coffee shop stretches around the block every morning. You can notice that every person in your office is talking about the same new software. You are living in the real world. You see consumer trends before analysts put them in spreadsheets. You experience products before they show up in earnings reports. Lynch called this doing your homework in the real world, and he believed it was more valuable than any research report Wall Street ever produced. Before Lynch invested in any company, he placed it into one of 6 categories. Not because he was rigid, but because each type of company requires a completely different strategy. Category 1, slow growers. Large, mature companies that grow slowly and steadily. Think utility companies or large industrials. They are stable and often pay good dividends. Lynch did not get excited about these, but held them for income. Category 2, stalwarts. Large, well-known companies that grow at a moderate pace. Think Coca-Cola or Johnson & Johnson. Not spectacular growers, but solid and dependable. Lynch looked to make a 20 to 30% gain and then move on. Category 3, Fast growers. These were Lynch's favorite category. Small, aggressive companies growing earnings at 20 to 30% per year. If you find the right one early, these are the investments that can turn a modest sum into life-changing wealth. Category 4. Cyclicals. Companies whose fortunes rise and fall with the economy. Airlines, steel manufacturers, car makers. The key is timing, buying them near the bottom of a cycle and selling near the top. Category 5. Turnarounds. Companies that have fallen on hard times and are fighting to recover. These are high risk but can produce extraordinary returns if the turnaround succeeds. Lynch made some of his biggest gains from turnarounds. Category 6. Asset plays. Companies sitting on hidden value that the market has not yet recognized. A retailer that owns all its store properties. A media company with undervalued content libraries. The stock price does not reflect the true worth of what the company owns. Understanding which category a company falls into tells you how to own it, how long to hold it, and when to sell. Peter Lynch invented a term that has become one of the most famous words in all investing: the 10-bagger. A 10-bagger is a stock that increases in value by 10 times your original investment. Turn $1,000 into $10,000. Turn $10,000 into $100,000. Lynch found dozens of them during his career at Magellan. Companies like Dunkin' Donuts, Taco Bell, La Quinta Motor Inns, Chrysler, and Fannie Mae all became enormous winners in his portfolio. And here's the crucial thing he discovered about 10-baggers. Most of them were hiding in plain sight. They were businesses that ordinary consumers encountered every single day. Restaurants people loved, stores people frequented, products people could not stop using. The mistake most investors make is thinking that great investments must be complicated, that they must involve emerging technologies or obscure industries or access to privileged information. Lynch proved the opposite. The best investments are often the most obvious ones, the ones staring you in the face every morning. The company whose product you cannot imagine living without. The store you visit every single week. The brand that everyone you know has suddenly started talking about. That is where 10-baggers hide. Lynch had a simple but powerful checklist before he invested in any company. First, he could explain the investment in 2 minutes or less. Lynch called this the 2-minute drill. If you cannot tell a friend exactly what the company does, why it will succeed, and what you think will drive the stock price higher, all in 2 minutes, you do not understand it well enough to own it. Complexity is the enemy of good investing. Second, he understood the business model completely. How does this company make money? Is the business simple or complicated? Is the product something people need or something they merely want? Is the company growing in a shrinking industry or expanding in a growing one? Third, he looked at the numbers. Lynch used a simple measure called the PEG ratio, price to earnings growth. Take a company's price to earnings ratio and divide it by its earnings growth rate. A PEG ratio below 1 suggests the stock may be undervalued relative to its growth. Fourth, he checked the debt. Great companies rarely carry excessive debt. Lynch always checked the balance sheet. A company drowning in debt has no room to survive a bad year, let alone take advantage of opportunities. Fifth, he looked for the edge, what he called the story. Every great investment has a story. Why will this company be bigger in 5 years than it is today? What is the competitive advantage? Is it expanding into new markets? Is it taking market share from competitors? Is it selling a product nobody else can match? Lynch believed that if the story was still intact, if the original reason you bought the stock was still valid, you held. The moment the story changed, you reviewed your position. Lynch was just as clear about what not to invest in as he was about what to buy. Avoid the next big thing. Lynch was deeply skeptical of hot industries. The companies that attract the most excitement and media coverage are often the most dangerous investments. When everyone is talking about an industry, the easy money has already been made. You are buying the hype, not the value. Avoid companies with exciting names and no earnings. Lynch loved boring companies with boring names and great earnings. A company called Automatic Data Processing sounds dull. A company called Integrated Artificial Intelligence Solutions sounds thrilling. Lynch would almost always choose the boring one. Avoid whisper stocks. A whisper stock is a company someone told you about at a party. Someone who heard it from someone who heard it from someone else. By the time a hot tip reaches you through a chain of friends and acquaintances, it is almost certainly too late, and quite possibly wrong. Avoid companies where insiders are selling heavily. There are many reasons why an executive might sell shares in their company, but there is only one reason they buy. They think the stock is going up. Lynch always watched insider buying as a positive signal. Heavy insider selling was a warning. Peter Lynch retired from Magellan in 1990 at the age of 46. He had made enough. He wanted time with his family. But before he left, he wrote down everything he had learned. In a book called One Up on Wall Street, a book that sold millions of copies and remains one of the greatest investing guides ever written. The lessons he left behind are as relevant today as they were in 1989. Know what you own, and know why you own it. This is Lynch's most repeated principle. If you cannot explain in 2 minutes exactly why a company will be worth more in 5 years, you have no business owning it. Ignorance is not an investing strategy. Invest in what you know. Your daily life is a research laboratory. The stores you visit, the products you use, the services you rely on, all of these are potential investments. The edge you have over a Wall Street analyst is that you are living in the real world, and they are staring at spreadsheets. The stock market is not the economy. Lynch often reminded investors that stocks and the economy move independently in the short term. Great companies can decline temporarily during good economic times. Terrible economies can produce great stock returns for patient investors. Do not let economic headlines drive your investment decisions. Hold your winners. Be honest about your losers. Lynch described a common investor habit he called watering the weeds and pulling the flowers. Selling the stocks that have gone up because you feel clever for the gain. Holding the stocks that have gone down, hoping they will recover. He said most investors do exactly the wrong thing. Let your winners run. Cut your losers when the story has genuinely changed. Invest for the long term. Always. Lynch checked his stocks roughly every few months, not every few hours. He believed that trying to predict short-term market movements was a waste of time and almost always costly. The stock market rewards patience. It punishes impatience. Peter Lynch did something remarkable. He proved that ordinary people, paying ordinary attention to the world around them, could beat the most sophisticated investors on Wall Street. Not by working harder than the professionals, not by having access to better information, but by using something the professionals had lost: common sense. The next time you walk into a store and think, "This place is always busy," or you try a product and think, "I would never stop using this," or you notice that everyone around you is suddenly talking about the same brand, do not dismiss that observation. Investigate it. Research the company. Understand the business. Check the numbers. Find the story. Because the next 10-bagger might not be hiding in a complicated algorithm or a secret Wall Street tip. It might be hiding in the car park of the restaurant you had lunch in last Tuesday. That is the lesson of Peter Lynch. The advantage was yours all along. If this story inspired you, subscribe to Wealth Doctrine for weekly investing wisdom. New video every week. And drop a comment below. Have you ever noticed a business in your daily life that turned out to be a great investment? Tell us your story.